don't fight the Fed. Markets crash while gold and silver boom. And Fed's Waller, we need a fast rate hike, but not a Volcker moment. One key thing he says in this article down the bottom, he says, but Volcker, Waller noted, had to battle inflation that had been building for 6 or 7 years. The current Fed is dealing with a surge in inflation that only began early last year. So that's on the back of, well, we don't need a Volcker moment because, Volcker jacked up rates by as much as 4 percentage points at a time. So we don't need to do that because, he had 6 or 7 years of this inflation building up. We can go softly. And that's actually what the Fed said in the early 70s. And what did we get? 1974, 73, 74, we had the S&P 500 fall 50% in nominal terms, while CPI was at 12.5%. And I'm saying, I believe we're going to see something similar. Now, Fed's Bullard says central bank must put brakes on economic activity. He says the US Federal Reserve must put the brakes on economic activity to tackle surging prices. In an interview with the Financial Times, he says it's a fantasy to think the Fed can tame the fastest US inflation in 4 decades without aggressively raising interest rates. He said, we have to put downward pressure on the component of inflation that we think is persistent. US officials estimate the neutral level for the federal funds rate to be around 2.4%. Bullard, in comments to reporters last week, said he would like to see the policy rate raised to 3.5% by year's end, a goal that would require half-point rate increases at each of the Fed's 6 remaining meetings this year. There you go. By the way, the neutral level, so-called neutral level, is much higher than 2.4%. You're kidding me. And then it goes on to say that there's some division, regarding inflation, that the signs overall that inflation may be peaking. Well, guess what? In the early 1970s, actually right through the 70s, we heard the same thing. Oh, inflation's peaking. Look, it's coming down. It's coming down. Oh, no, it's not. She's going back up again. Oh, it's coming down. It's coming down. Oh, no, it's not. It's going back up again. Now, someone else that's been talking about what the Fed needs to do is former Fed President Bill Dudley. Now, you got to remember these guys are all Keynesians, okay? And their economic model, they basically have now admitted that the economy is no longer about saving, investment, and production, producing actual things, that it's financialized. That it's this, this Keynesian wealth effect. If only we lower interest rates, we create easy currency, easy money, they say, easy currency, increase credit, have this credit Ponzi scheme happening, we can increase asset prices. What does that do? Makes people feel richer, apparently. So then they'll go and borrow against those rising assets to then spend in the economy, to consume. The word consume literally means to destroy. Go look it up. To consume. And so we just create this Ponzi scheme. And so that's where they admit our economy has been. And, well, it's now overheating. We have inflation. They've created too much of this. They've gone too far on the so-called wealth effect. So what do they think is the quickest way to tame inflation? Well, to reduce the wealth effect, which means raise interest rates and raise them aggressively to bring down asset prices, to crash the property market, to crash the stock market, so that people will feel poorer, so that guess what? They'll pay off debt. They will spend less. Yes, unemployment will rise. Yes, it is likely that there is no such thing as a soft landing and we will go into recession. So let's just hear from former Fed President Bill Dudley.
Volcker and Brainerd inflation. What's different with this 7-8% versus a 7-8% when you were certified at Berkeley?
I think the difference is that the inflation that Volcker had to fight built up over a long period of time. And so inflation expectations started to rise pretty significantly. So it's much harder to get rid of the inflation than the inflation we have now. The good news is that the inflation expectations are still relatively well anchored. So that would imply that the Federal Reserve isn't going to have to do quite as much to push inflation back down.
Your line in your piece this morning in the lead paragraph, Bill, I think has got everyone's attention, so I'll repeat it for everybody who hasn't heard it so far. To be effective, it'll have to inflict more losses on stock and bond investors than it has so far. Bill, run us through financial conditions and how you gauge financial conditions and why you might believe that stocks are a big part of that.
Well, financial conditions are important in the United States, and Chair Powell has emphasized this in his prepared remarks because that's how monetary policy works. The U.S. economy doesn't really run on short-term interest rates. It really runs on long-term interest rates, and the stock market is also important because a lot of people have exposure to the stock market, and the level of the stock market affects their wealth. So the Fed has said pretty clearly, we need to tighten financial conditions to slow the economy down to keep inflation in check. And so far, financial conditions really haven't tightened very much. The stock market is only 4% or so off its high. It's still up very sharply from where it was a couple of years ago. And bond yields, 2.5, 2.6%, are still really low, especially when you adjust for inflation. So in my mind, the Fed hasn't really accomplished much yet. And if financial conditions don't cooperate with the Fed's going to have to do more until financial markets do cooperate.
Bill, talk a little bit about the consequences of this. If stocks are a reflection of sentiment, if they affect the way that people are willing to go out and make purchases based on their household wealth, what does that do to the economy? Are you basically saying that if things continue the way they are, the Fed is going to have to torpedo growth to a potentially recessionary degree?
Well, the Fed right now is, markets are pretty confident in the Fed's program because they have the Fed taking the short-term rates up to about 3%. That causes the economy to slow, and then the Federal Reserve eases policy in 2024 and 2025, and we have a soft landing and live happily ever after. I don't think it's going to be that easy because the markets are so confident in the Fed, the financial conditions are still quite buoyant. If financial conditions are buoyant, that means the Fed has to do more to slow down the economy. Also, a soft landing is very, very hard to achieve when the unemployment rate is so low. The soft landing examples that Powell has cited, 1965, 1984, 1994, were all examples where the Fed tightened and the economy slowed, but did not slow sufficiently to push up the unemployment rate. The unemployment rate in all three of those episodes kept declining. I think in the current environment with the unemployment rate at 3.6% and wages running well above a rate consistent with 2% inflation, the Fed's going to have to tighten financial conditions enough to push up the unemployment rate. And when the Fed has done that in the past, it's always resulted in a recession. That's not their intention. They'll go for a soft landing, but their chances of pulling off are very, very low.
Do you think that rapidly reducing the balance sheet, Bill, will be enough to achieve this sell-off that you think is necessary in order to enact some of the tightening that the Fed is trying to achieve?
Well, certainly we'll work in the right direction. Obviously, quantitative easing helped pull down long-term yields, and I think as you reverse course, that should push them up. But we don't know by how much. We already know what the Fed's going to do, and markets haven't really moved very much. So, I think it's just a big wild card in terms of how much will the quantitative tightening do the Fed's job for them. I think the big point I would just make is just it's very unlikely that a year from now we're going to be at this level of bond yields this low and this level of stock prices this high, because that's probably not sufficiently tight financial conditions to do the Fed's job for them.
Now, I just want to share with you guys a quick clip from former New York Fed trader Joseph Wang, who argues don't fight the Fed when they're cutting rates and pumping liquidity into the markets, pumping markets up, and vice versa. Don't fight the Fed when they're sucking liquidity out of the market, raising interest rates, and asset prices fall.
Will the Fed weigh equity returns year to date when determining how fast to tighten monetary policy? Thanks.
What?
Dylan, is how closely is the Federal Reserve paying attention to the stock market?
Very closely. I mean, just listen to what Dudley said and what George mentioned, right? This is a major pillar of how monetary policy actually affects the real economy. It's through the stock portfolios of the American public. So if you want inflation to be lower, you got to reduce demand. One way to do that is to reduce net worth. If your stock portfolio is smaller, you'll have less money to buy stuff. That's less demand, that's less inflation. So, former President Dudley of the New York Fed has already spelled this out to you. You guys don't fight the Fed.
Don't fight the Fed. Joseph, it's interesting. I was just speaking with Urian Timmer, head of macro strategy at Fidelity, and we were looking at some of his charts on risk premia, credit risk premia, and equity risk premia. And even though financial conditions have tightened, it's all been because of a rise in the risk-free rate. The 2-year, the 10-year, the 30-year credit spreads have barely budged, and equity risk premia are actually lower than they were at the beginning of the year. So the market is still in risk. The market is fighting the Fed, Joseph.
Oh, they're going to lose. They're going to lose so badly. I've been telling you guys this since the beginning of the year, and we've gone down a lot since then. We bounced a bit, but we were still too high.
So I did this video, Market Crash and Gold and Silver to Boom, 2 months ago, where Jim Bianco basically laid it out in a quick little 4-minute clip where he said that the Fed now has political permission to raise rates to fight inflation, that inflation is hurting the Biden administration politically. And now this has moved from being economics to political. And as someone who's worked in politics and been an advisor before, my wife has worked for politicians. We understand the game of politics. You know what? Let's just cut to a clip with Jim Bianco from this video where you'll see what I'm talking about.
Percent drawdown, even a 10% drawdown is something to make the Fed chair get out of bed and maybe reverse course. But you're saying in this new inflationary world, the Powell put has a much lower strike price.
Exactly right. Exactly right. If you want to put it in market terms, is the strike price has been lowered, and it's been lowered quite a bit. And the question is, why is inflation now the priority and not growth? And I think it's about politics. And by the way, most money managers that I talk to, they're pretty bad at predicting politics. They either don't want to do it or don't believe it matters, or they're partisan in some way and they don't want to let it show one way or the other. But as a group, get 5 money managers in a room or 10 money managers in a room, ask them about who they think is going to win the election, take the other side, you'll be Nostradamus, is basically the way that crowd typically works. And you know what? They'll tell you that too. The problem now is with inflation, it hits everybody. Inflation, you, me, everybody listening to this podcast is hit by inflation. However, there's a big difference. The survey of consumer finances says that the Federal Reserve study done every 3 years, that 40% of the public has less than $1,000 of savings in rents. So when prices, 7% inflation, goes up more than wages, which has been the case, so you have negative real wages, the 40% see it at the grocery store, at the gas pump, at the mall, every single time they go to the store. And they're not happy about it. And that is showing up in things like consumer confidence, the University of Michigan's consumer sentiment surveys at a 10-year low, The president's approval rating is in the tank. Congress's approval rating is in the tank. The Democrats are panicking because the Democrats are the majority. So we're going to look at it from their point of view. They're panicking that they're going to get wiped out in November. And so when asked in a lot of surveys, what is the number one issue in the country? It is inflation. It is not crime. It is not COVID. It is not foreign policy or Russia. It is not climate change. It's none of those things. It is inflation. It's the number one issue. So in last month's press conference, President Biden's press conference, he acknowledged inflation is the biggest issue in the country today.
Now, the second challenge we're facing are prices.
And he said, in 2 sentences, he said, here's what we're going to do about it. This is President Biden speaking. Here's what we're going to do about it. The job to make sure inflation does not become entrenched falls to the Federal Reserve.
A critical job in making sure that the elevated prices don't become entrenched rests with the Federal Reserve.
In other words, he said, America, you're pissed off about inflation. You hate us about inflation. Well, here's what we're going to do about it. There's this guy named Jay Powell. He's going to fix it for you. And by God, Jay Powell is going to fix the inflation problem. And if equity holders or bond holders have a problem with it, you have a problem with it. The priority now is inflation.
So late last year, I shared a video, my 2022 predictions. I said CPI could hit 10%. Well, we're close. We're at 8.5%. And that's the official government numbers. We know that that's not quite the real numbers. I said price controls. I wouldn't be surprised. And that's still being talked about. So not ruling that out. I said 3 rate rises followed by power pivot. Now, a lot of people, there's a debate over how high interest rates will rise before the Fed and all central banks will break something, will break the stock market, bond market, housing market, you name it. And so there is that debate. And then, I guess my base case back then was that we'll see Powell do another power pivot like he did in 2018. Fast forward, where do I sit now? I think that the inflation is a political issue now. And so they do need to fight it. They're going to try to do some kind of soft landing where asset prices come down. They can raise rates to 2-3%. The question is, did they break something before then? And as soon as things break, do they stop? Or do they keep going? That's the big question. Now, I also said stock market crash, value over growth. And that's one of the reasons why is the headwinds with both interest rates rising and quantitative tightening, taking liquidity out of the market. That's been a big tailwind for asset prices. That then becomes a headwind for asset prices. So stock markets, housing begins to decline. I said silver to $30 and then $40. And I think when silver can break that $30 mark, it's then will some technical buying will kick in, which will take it up to 40 in a very quick period of time. And obviously, there's my golden outlook for this year. I think CBDC rollout will begin later in the year. So Ilya Sikowski said that the Fed has 2 options. 1, soft landing, let inflation run, yields rally, and gold replaces treasuries as world reserve asset. 2, shock and awe, housing, crash housing, and forex market with quantitative tightening and reset system with the IMF's new Bretton Woods moment. Nobody said it was easy. What's interesting is Professor Richard Werner says crashes and recessions are policy goals. Glad you recognize it. See my book, Princes of the Yen. And I've talked about this in other videos, that we could be seeing a Princes of the Yen moment happen. Now, if you don't know about Princes of the Yen, you can read his book. Go to quantumpublishers.com, read it, or watch the documentary movie on YouTube called Princes of the Yen. Now, this is a really good chart. Fed hiking cycles end with deleveraging events. So every time the Fed has hiked, it is ended with a deleveraging event. And so you can see every time the Fed hikes, it gets lower and lower and lower because they just go, "Oop, we're sorry," and we start cutting rates again. Once again, the question is, do they do that now? Do we see another power pivot? Or do they say, no, we are fighting inflation. It's a political issue now. It's not so much, we don't even care about economics. It's now political. And this is going to be very interesting. Jamie Dimon said, we'll not use liquidity now to buy longer-term securities to boost interest income, given chances of hits to regulatory capital. There you go. They're not interested in helping the Fed with quantitative tightening. So this is going to be very interesting if this is the case. That the world is really at a cross point right now. And when we look at this chart going back to the early 80s, the federal funds effective rate and the CPI. And, well, the federal funds rate, it just cannot remain this low while we've got CPI at 8.5%. And that's, that's measured not according to the same measurements from the early 80s. So, the federal funds rate has to rise. The question is how much. And if this chart's anything to go by, the federal funds rate needs to rise a lot. Problem is, we've got a lot more debt in the system, both on a household, corporate, and sovereign level. And if the 1970s are to give us any guide, the Fed kept raising rates to try to offset those waves of inflation. And I believe we're going to have those waves. This whole talk of peak inflation, don't buy into it. Remember they used to tell you it was transitory. Please believe it's transitory. Believe it's transitory. And you know what? A lot of people did. Now they're saying peak inflation, peak inflation, peak inflation. Don't believe it. We're going to have spikes like in the 1940s, like in the 1970s. And, well, just be careful with your portfolios, with taking on too much debt. Yeah, if you can lock in a, low 30-year, well, you probably should have done that last year against some debt and, in an inflationary environment, which I think, in my opinion, I could be completely wrong. That's why we don't give financial advice on this channel. But I think we're in an inflationary decade ahead. And with that, I think you want to own inflation hedges. You want to own real assets. Once again, not financial advice. But for me, I believe holding, for me anyway, holding physical gold and silver, holding gold and silver miners, explorers, other commodity producers, energy producers, soft commodities as well as hard commodities. These are the things that you want to be, or I am invested in, because that's what I think's going to happen. When the S&P 500, I've talked about this before, 73, 74, the S&P 500 fell 50% in nominal terms. While CPI was at 12.5%. And I see the same thing again. I see central banks raising rates, which is going to put big pressure on asset prices. The S&P 500, the ASX 200, the property market. Property markets, especially in Australia, is so stretched. And, at the same time, it's not really going to bring down inflation. Yeah, it might bring it down a little bit. And people will say, see, peak inflation, blah, blah, blah. But with that, gold and silver will perform well. I think gold will perform exceptionally well. Silver is a lot more volatile. But I talk about this a lot. Wealth cycles. Measure your gold and silver versus other assets. And that's what I do. And it works well for me. And I believe that we're headed in that scenario again, where gold and silver will outperform relatively to the stock market and to the property market. And so I think, at some point, I will roll, especially my silver, into other assets. But not until there's been some blood on the streets. And I think we're going to see that. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. If you haven't yet subscribed, do so and hit that notification bell. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.